Hello, I'm Graeme Investment, Chief Investment Officer, with an investment update on the 10th of August 2022. I'll talk about the economy and what the implications are for investments across asset classes. At the moment, we seem to have a bit of a slowing in the economy, both in the US and in Australia. We're seeing that from some of the business surveys out and consumer sentiment, which is quite low. We're at the lower stage of optimism about the future, and that's really governed by a lot of what's been going on with rate hikes by central banks. So the RBA's continued to hike rates, which has affected households. Oil prices have been up, and petrol prices are not helping, and floods have also impacted vegetable prices and other things in the economy. So households are reasonably stretched at the moment, but they do have some capacity. What we're seeing in the US, even though they're in a technical recession with 2 quarters of negative growth to June, there's still a lot of growth in that economy happening, and employment growth is still very, very strong. So you might say, what's the problem when we have very low unemployment in the US and in Australia, and the only thing that's really hurting us is interest rates going up, which hopefully most people are ahead on their mortgages. The implication for markets, though, is that they're looking through to the other side of this, and even though we see further in an economic downturn or slowing, there may or may not be a recession. Equity markets and bond markets will price what they think is going to happen in the next 6 to 12 months, and they will typically bottom or peak 6 to 12 months before the actual economic peak. So we still do think that equities should be underweight, and that we're cautious about how we position in equities, so more defensive, more quality-oriented companies there. And in bonds, we still think there's a potential default cycle to come, with corporates being more stressed and having more input pressures on their costs and wage prices going up. So we think that some corporates will potentially default, and credit spreads on those corporate bonds will rise. We're seeing opportunities now that interest rates have risen in fixed income. So there's different areas of fixed income that we're rotating towards, and we're being defensive about the most high yield fixed income instruments because of that potential default cycle. Property may have some stress, but also some opportunities. So we're focusing there, aside from listed markets, in unlisted opportunities, and particularly opportunistic opportunities as well. Across alternative assets, we're seeing opportunities that will come up through the cycle, from private debt opportunities, private equity, venture capital. At this particular point of the cycle, there's less capital being deployed into those areas, and it's actually a better time to buy. Across other areas, we see opportunities in agriculture and infrastructure, given that they're inflation linked, and there'll be a lot more activity to look at inflation hedging in portfolios. And we're looking at that in all portfolios as to what can be put in to help defend against higher inflation. That said, we think that markets are pricing in a likely peak in inflation soon, as we've seen oil prices come down and some of the supply constraints get better. So with that environment, we're seeing a very dynamic environment, some opportunities there, but mostly we're being defensive, and we think there's some further moves to happen down the track where we will make some adjustments to equities, looking to buy back in at some point. So that's it for the market update, and I'm happy to answer questions next time we speak. Thank you.